I watched the founder give up 35% of his company for $4 million. 6 months later, his revenue had tripled. His team was executing. His product was gaining serious traction. If he'd waited, if he understood the timing, he could have raised $8 million at half the dilution. Now, the difference wasn't the business. It was when he went to market. And here's what nobody tells you about raising capital. Most founders get the timing catastrophically wrong. They either raise too early before they've hit the milestones that justify a premium valuation, and they give away the company for pennies on the dollar. Or they wait too long. They're down to 90 days of cash, 90 days of runway, and that's it. They're negotiating from desperation, and investors unfortunately can smell that. When that happens, terms get worse. Valuations drop. You take a down round just to survive. Or worse, you take a predatory convertible note that destroys your cap table. I've seen both scenarios play out hundreds of times across 37 billion in closed transactions, and the pattern is always the same. Founders who understand when to raise capital, who know how to time it right, consistently 30 to 50% higher valuations than founders who don't. So this video is your complete guide to raising capital in 2026. In the next 10 minutes, I'm going to show you the exact framework we use with clients raising anywhere between $5 million to $2 billion. You'll know the 3 triggers that tell you it's time to raise, the 5 mistakes that kill your valuation before you ever talk to an investor, and most importantly, the specific signals that institutional allocators look for before they write a check of this size. And by the end of this video, you'll know exactly whether you should raise capital now or what you need to fix first. So let's get into it. Section 1 is why timing your raise is the most underrated decision you'll make. Here's the truth that most fundraising advice completely ignores. When you raise capital matters more than how much you raise. Raise too early and you're selling equity at a discount. You haven't hit the milestones that justify a premium valuation. Makes sense. You're trading future upside for capital you might not even need yet. And now, flip side, you raise too late and you lose all the leverage. When you're down to 4 months of runway, investors know you need them more than they need you. And that desperation, well, we all know what happens. It's going to cost you 20 to 40% in valuation, sometimes more. I had a client last year, 18 million ARR, SaaS infrastructure play. They came to us with 14 months of cash. We ran a structured process, targeted the right institutional investors, and closed 22 million at $180 million post-money valuation. 3 months into the process, one of their competitors ran out of cash. Same revenue, same market, same growth rate. A competitor had to take a flat round. Same valuation as their previous raise just to keep the lights on. That's not where you want to be. The only difference was timing, and that timing difference was worth $60 million in founder equity. So how do you know when it's time to raise? There are 3 primary triggers we look for when advising a founder on whether now is the right time to go to market. If you hit at least 2 of these 3, you are in the window. And now if you hit all 3, you need to move fast. So let me walk you through them one by one. Section 2, the 3 triggers that signal it's time to raise. Okay, trigger number 1, your runway is under 12 months and you can't self-fund the next major milestone. Now here's the math most founders miss. Fundraising takes time. If you're raising institutional capital, 5 million and up, you're looking at 90, 150 days from first conversation to closed wire. Sometimes longer if you're raising 50 million or more. Anything under that is just unrealistic. I'm not saying it's impossible, it's just not realistic. That means if you wait until you have 6 months of cash left, you are already behind. You're now fundraising in month 1, closing in month 4, and hoping absolutely nothing goes wrong. And when investors sense that urgency, when they know you need the capital to survive, they tighten terms. They add liquidation preferences. They negotiate down the valuation because they know you don't have leverage. I mean, what would the sharks do? The right time to raise is when you have 9 to 12 months of runway left. You're not desperate. You can walk away from bad terms. You can run a competitive process. And that positioning alone is worth millions upon millions in valuation protection. We had a client come to us last year with 14 months of cash. We structured the raise. We built a targeted investor list, ran a process over 120 days, and we closed 22 million in terms that protected the founders. If they'd waited until month 6, we would have been negotiating from weakness. Now, the same deal would have cost them 25% more equity. Trigger number 2, you can clearly articulate how the capital will scale revenue, defensibility, or valuation, and you can prove it. Investors, they don't fund general growth. They fund specific, measurable outcomes tied to capital deployment. If I ask you, where's the next $5 million going? And your answer is, we're going to hire some people and expand marketing. That is not a plan. That's a wish list and a red flag. Here's what institutional investors want to hear. $2.5 million goes to enterprise sales expansion. We're hiring 6 account executives, 3 sales engineers, and a VP of sales based on our current CAC of $8,000 and LTV of $120,000. That gets us from $12 million to $30 million ARR in 18 months. And the other $2.5 million funds product expansion into vertical SaaS for healthcare, which we've already validated with 3 signed LOIs representing $4 million in forward revenue. Now that's a plan. That's fundable. That's what they want to hear. If you can't map capital to outcomes with that level of precision, you're not ready to raise institutional capital. You're ready to build a better financial model. Okay, trigger number 3. You're at momentum inflection point. And when the window's open, investors fund that momentum, not maintenance. The best time to raise capital is right after you've hit an inflection point, but before the momentum flattens. So what does that look like in practice? You just signed a strategic partnership that opens a new distribution channel. You hit profitability for the first time and can now prove unit economics at scale. Revenue is doubling year over year, and you need capital to capture market share before competitors move in. You just made a key executive hire, former VP from a public company, and that signals operational maturity to investors. These are the moments when investors lean in because they're not betting on potential anymore. They're betting on acceleration. We worked with a client in the energy infrastructure sector. They had just secured an offtake agreement with a Fortune 100 company, $60 million in committed revenue over 5 years, I think it was. We took that to market and closed $35 million in Series B in 90 days. The inflection point created urgency on the investor side, not ours. And